I want to start by really trying to sit. I want you to sit in your seat for a minute and see, like, imagine that you're a college student, perhaps in your a second or third or fourth year in Houston. And I want you to imagine that you're pushing through a graduate program. Your life is a nonstop blur. Money arrives in fits and starts. A scholarship refund, a check from a family with when they can swing it in, a paycheck that evaporates almost instantly on rent, groceries, textbooks that cost more than a week's pay, maybe the first trickle of student loan bills. Some weeks you end up with a positive balance of 20 to 30 bucks. Others, you're calculating precisely how far one pack of instant noodles can stretch until the next deposit hits. And in those quiet pockets, walking across campus at dusk, lying in bed, scrolling, or sitting in the library between classes, you have this nagging thought. Is there any realistic path for someone like me to start building a real lasting wealth? Or do I have to grind through graduation and not land a full-time job and pay my loans and then only think about investing after all that? So I'll give you the answer up front because it's one of the most empowering things you'll hear in your 20s. This exact stage of life, even when you're a student, is one of the best windows to start investing. And it's not because there's going to be some magic bull run or you have like a big bankroll. The most valuable resource you have right now is your time. 3, 4, even 5 decades ahead of for compounding work to work its quiet miracle. Even some small consistent amounts like 20, 30, 50, or even $100 per month pulled away from your earnings, like side hustles, maybe birthday money, or not going out to eat with your friends every once in a while, can have a huge impact on your future. At a conservative long-term real return of about 7%, $50 a month starting today could realistically compound to about 80 to $100,000 over 40 years. If you gradually scale to $100 a month after graduations, 100 to 200 a couple years later as income rises for a lot of people, you're usually looking at 200 to $400,000 or 100,000, yeah, $100,000 by your 60s. And as I live in Houston, Houston quietly stacks the deck in your favor. The cost of living is 6 to 7% below the national urban average. So a lot of the housing is cheaper, utilities is cheaper, and transportation is also cheaper in Houston. So limited dollars go further, freeing up tiny sums without feeling like deprivation. So that's the foundation I want to build on today, a deep, clear, no nonsense analytical overview of how investing actually works. Not the get rich quick, oh, do this and you'll make $100,000 type TikToks or the panic headlines about the latest dips or crypto millionaires, but the mechanics, the mathematics, the analysis, and the historical evidence that lets ordinary students like you start planting seeds for for extraordinary futures. And my name's Lakshit Kumawat. And for the last 3 years, I've lived and breathed markets, studying patterns, building portfolios, and advising a lot of people across every different phase of their lives. I work closely with a lot of students and recent graduates who've been working on exactly what situation you could be in: cash strapped, ambitious, skeptical, but curious. My goal over the next couple of minutes is to take investing out of the realm of mystery and intimidation and place it firmly in your hands as a simple, controllable, powerful habit you can adopt right now. Let's start with the fundamentals. What is investing really? When we peel back every layer of the hype, investing is a deliberate choice to direct a portion of your money, however modest, towards productive assets that have potential to create additional value over time. Rather than just letting your money sit in a checking account earning nothing or maybe pennies, high yield savings accounts are paying 4 to 5% these days, which is really good for short term safety or emergency funds. But after taxes and long term uh, inflation, historically around 3%, your real growth is very tiny. You're preserving your money and you're not multiplying it. Investing changes the game because you're acquiring ownership or lending to the entities that generate real economic output. Companies building software, inventing medicine, driving or delivering packages faster. Governments or corporations borrowing to fund infrastructure and paying interest. properties collecting rent over time. Over decades, those assets tend to reward patience through price appreciation, dividend payouts, or interest income. And a metaphor is that saving is like storing seeds in a sealed jar in your dorm room. They're safe from theft or loss, but they're just seeds forever. Investing is like planting them into good soil, watering them consistently, protecting them from the harshest weather, and giving time to let them grow into a forest that will give you shade, fruit, and legacy. Risks are real though. Markets aren't smooth. We've seen major storms. The 2008 financial crisis plunged the S&P 500 50%, peaked to thorough over about 17 months. The 2020 COVID crash was around 34% in just a few weeks. 2022 also brought a really big downfall, around 25% because of soaring inflation and rate hikes. Each felt catastrophic in real time. People panicked and sold all their stocks on lows and locked in on losses, yet each recovered. Post 2008, the market doubled in under 5 years and kept climbing. Post 2020, it hit new highs and it's still hitting new highs. And post 2020, like I said, it rebounded and it went back up. Why? Because beneath short-term chaos, the economy grows, innovation accelerates, productivity rise, and populations demand more goods and services. Since reliable records began in the late 1920s, the U.S. stock market has delivered an average annual total return of approximately 10% nominally after inflation, that's roughly 7% real growth per year, not every year, not promised forever, but the multi-decade pattern is remarkably consistent. So tools that you can use as a student are accessible and beginner friendly. You can use stocks to get small amounts in companies and allow you to kind of just begin your portfolio and learn how to use your money wisely. Bonds are also really safe and trustable, and their loans basically they're loans to governments or corporations. You get steady payments and principal is returned at maturity. Lower returns and much lower vitality. Portfolio anchor. Another one is index funds and ETFs, the practical powerhouse. These low cost baskets track broad markets. And the top 2026 options are the Fidelity Zero Large Cap Index, Schwab S&P 500 Index, and Vanguard Total Stock Market. Diversification is built in, and one bad company or sector barely registers. Markets are endless auctions reflecting human mood swings. Greed inflates bubbles. Fear triggers crashes. Corrections are normal. They realign prices with fundamentals. The long trend rises because human ingenuity solves problems faster than ever. And our psychology is the biggest risk. Loss aversion uh, leads to selling low. Recency bias makes us chase winners to or free recent losers. Herd mentality fuels FOMO at peaks. Panic at bottoms. The 2022 bear market saw many young investors selling out of fear, missing the strong rebound. The fixed systems over emotions, automate contributions, choose broad allocation, 90 to 100% stocks when young, and rebalance yearly. Step away. The true superpower is compounding. Earn returns earn returns on themselves exponentially, not linear. So, a situation for a realistic student, about 7% real return, conservative. So if let's say you're doing 30 months or $30 per month, which is about like your part-time saving you can put in. After 40 years, you would have around 70 to $80,000. And if you bump that up to around 50, it would go all the way up to around 300 to $500,000. And if you start bumping it up after you get steady income to around 200, you could also see upwards of $500,000. So for young people right now, the most practical roadmap would be a tiny emergency fund, so around 500 to even $1,000 just in savings, and then Roth IRA if you have any income, like even if you're doing like a summer program or doing like an internship, that's also great. and it's good because it's tax-free growth and contributions withdrawable without penalty free if needed. And then you can also start micro if you don't have a lot of money. You can start to around $20 to $50, and you can use apps like Fidelity Zero, Schwab, S&P 500, Vanguard Stock Total, apps like Acorn Roundup Purchases. And you can also automate cost averages. And loans are also a good option. You should prioritize high interest aggressively, and you should invest anyways. You also have time in your side, so you're gonna win. And also living in a city like Houston will give you a huge edge because you'll have lower COL stretches, small amounts. And then this is like a recent example of something I did. So a computer science student I knew, he started with around $25 per month from barista shifts, and then he automated that into Fidelity Zero. And then the market dipped, and then years later it was compounding. And the biggest lesson was learned from that person was starting from small beats, and then you wait for the perfect moment. Investing works for students because it's time times consistency times math. Not needing wealth right now, you're ideally positioned. So the challenge I have is for the next 10 to 15 days, open a Roth or brokerage account and automate $10 to $50, whatever you can do, and pick one broad fund and let it grow while you do your studies or go to college or do whatever you're trying to do. And this builds freedom, less loan anxiety, career choice, family time, impact, etc., etc. And you should start tiny and start now. The curve is the steepest at the beginning, and you're here. Thank you.
Yeah, I think that was an incredible speech from Lakshit. I think that really gave us insight into how young people, especially, should start investing and how really they should be able to actually start up their portfolio. And your experience really shows in this talk as well. So we have some comments right here as well that are coming through. So the first one I think is from Stephen. Kavin, can you pin that real quick? Yeah,
Mhm.
so Stephen Navarro is asking, what do you think about investing tools as in more technical like AI/machine learning/data learning?
I think AI is really good. AI and machine learning is really good for stocks, but I think you should be a little more careful because sometimes the algorithms might not catch all the data you use. So you should kind of be careful when you're looking into that. But in the future, after AI develops more, I think it would be a great idea.
Yeah, I think we have another question
Uh,
from Inspire X, I think, Kavin. So it says, can you explain exactly how you got into investing and were able to grow your portfolio?
Okay, so this is a funny story, but a bunch of my friends we had this one crazy idea of just doing investing. So we just started investing little, like not huge amounts, but we just started investing little amounts in different companies and just seeing how much we could grow. It was like a competition mostly, and it was just for fun. So yeah.
Yeah. And then one last question from Ninja, I think. So it says, Lakshit, obviously, you here in the US, millions of people invest in 401k retirement plans, but we've seen lots of uncertainty due to tariffs. How do you think the working class investments have been affected by these tariffs?
I think the tariffs have affected the economy really badly, like as you can see in some of these companies. But I think on the longer side, I think it shouldn't really impact you that much if you keep on like growing and not just selling all your stocks like as they go down. So I think being consistent and spreading your money into different stocks and different companies will help you have a good portfolio.
Yeah. Okay, so thank you for being here,
Yeah.
Lakshit.
Thank y'all
Have
too.
a good afternoon. Thank you.
Yeah. Thank you. Bye bye.
There is always an opportunity to contribute to the discussions that we have at EnviroCast Geo. If you are interested in attending or even speaking at a future conference, learn more at geo.envirocast.org. We're excited to hear your insights.